As the book is telling you, there's two methods to record accounts receivable. The first one is direct write-off, and the second one is the allowance. So let's look at the very first one, the direct write-off method. It's pretty simple. For example, you've got a non-collectible account of $600, so somebody notified you that they're defaulting. They will not be able to pay $600 worth of accounts receivable to you. If you have an expired or bad asset, it becomes your expense. So we are going to credit account receivable for $600 to get that bad asset off the books, and we're going to record it as bad debt expense. It's your regular expense account, so normal balance for that account will be debit. Take a look what could happen next time. I'm just going to go ahead and rewrite it because I didn't realize that bad debt expense will not be on the next slide in accounts receivable, $600. If it so happened that the person decide later to mail in the check for $600, let's say he would like to continue a financial relationship with you and he's willing to pay off, he's in a better financial situation. Now all we're doing is getting that bad account receivable out of the trash can and reinstating it on the books. So I'm going to debit accounts receivable for $600 and credit bad debt expense for the same amount. Basically, we just reverse the journal entry. And then the second one will be to collect the receivable in cash. So debit cash, $600, and credit accounts receivable for $600. What's wrong with this method? Well, if you think about it, let's say this account receivable originated from the sale 2 years ago. So for 2 years, you've tried so hard to collect and you failed to do that. So now, 2 years down the road, you're actually recognizing an expense that corresponds to the sale. Well, if you remember from chapter 3, that is very poor matching again. Therefore, the direct write-off method is not allowed by GAAP. So under the accrual method, we will have to use the allowance that we're going to talk about next. Under the allowance method, at the very end of the year, you will simply look at your receivables or your sales and estimate how much will be uncollected for the upcoming year. For sure, you will not know the exact amount, but to estimate something is better than estimate nothing. And we will record an allowance for that amount. So just like in the prior example, we would debit bad debt expense, and we will credit an account you have not seen before. It's called allowance for doubtful accounts. And I will put X for the amounts because we will estimate the amount later. Just for now, try to understand how the journal entry works. The allowance is quite an unusual account. It's a contra asset account. It's contrary to the accounts receivable. So normal balance will be credit, if you remember your contra assets, and it will appear on the balance sheet right underneath your accounts receivable. And you have seen already bad debt expense before. Again, this journal entry is an adjusting journal entry that is done right at the end of the year. Then one starts, and here's your first uncollectible account of $600. How would you record that? Well, it's a bad receivable. Again, you got to get it out in the trash can, $600. But instead of recording the bad debt expense, you knew prior year it was coming, so you estimated that allowance. Now, on the rainy day, it's the time to use it. So we're going to debit allowance for doubtful accounts for $600. So, and it actually helps you. I'm going to move this $600 a little bit further away so it does look like a credit. Debiting the allowance account will actually reduce it because normal balance is a credit. Very similar to the direct write-off method, if you need to reinstate an account that was written off before, you're going to do the same thing. We're going to get our accounts receivable out of the trash can and put it back on the books. So I'm going to debit accounts receivable for $600 and credit allowance for doubtful accounts, $600, and then your regular journal entry to collect a receivable for $600. We're back to our adjusting journal entry at the very end of the year when we need to record your regular allowance, and we simply would debit bad debt expense for an X amount and record my allowance for the upcoming year. So this is your big picture. When you all said and done, your two methods would look like this. Obviously, direct write-off method does not have an allowance account, so there will be no journal entry to estimate the allowance. And there's, four. I kind of count that as a one journal entry related. Three journal entries that would be related to the allowance method.